If you had to build a portfolio today, and you couldn't constantly trade, and you didn't want to gamble on single stocks, what ETFs would actually make sense before 2030? Because here's the reality. The next 5 years will likely define the next decade of wealth creation. Artificial intelligence, demographic shifts, energy transition, government debt, interest rate cycles. Most investors are overcomplicating this. You don't need 25 positions. You don't need daily trades. You don't need to predict the next hot stock. You need exposure to the right structural trends efficiently. Today, we're breaking down 3 ETFs Americans should seriously consider owning before 2030. Not hype plays, not meme assets. Strategic, long-term vehicles. Let's start with the foundation. First, ETF, S&P 500 exposure. A low-cost S&P 500 ETF remains the backbone of most successful portfolios. Why? Because it gives you exposure to 500 of the largest U.S. companies in one position. Technology, healthcare, financials, consumer staples, industrials, and more importantly, productivity. Over the last century, American corporations have consistently innovated, scaled globally, and increased earnings. Betting against that long-term has historically been a mistake. Yes, valuations fluctuate. Yes, corrections happen. But broad market index exposure has outperformed the majority of active investors over long time horizons. The S&P 500 isn't just tech. It's American economic infrastructure. If the U.S. economy grows, the index tends to grow. Before 2030, we are likely to see continued AI integration, automation expansion, productivity improvements, corporate earnings growth tied to technology adoption. An S&P 500 ETF ensures you capture that. You're not trying to guess which company wins. You own the ecosystem. That's the foundation. Second, ETF. Total market or equal weight exposure. Here, S where nuance comes in. Right now, the S&P 500 is heavily concentrated in mega-cap technology companies. A handful of names represent a large percentage of the index's total weight. That creates opportunity, but also concentration risk. If mega-caps outperform, great. If leadership rotates, equal weight or broader market exposure may outperform. An equal weight ETF spreads capital more evenly across companies. That means smaller large-cap companies have a greater impact. Historically, during certain economic cycles, equal weight indices outperform traditional cap-weighted indices, especially when leadership broadens beyond just tech giants. Between now and 2030, sector rotation is very possible. Industrial reshoring, energy investment, infrastructure spending, healthcare innovation, small cap resurgence. If you only hold cap-weighted exposure, you are more dependent on the same few companies continuing to dominate. Equal weight exposure gives you participation in broader economic expansion. It balances growth with diversification, and it reduces the top-heavy risk embedded in today's market. Third, ETF, international developed markets. This is the one many Americans ignore. For over a decade, U.S. markets have outperformed international markets significantly. But market leadership rotates over long periods. Valuations outside the U.S. are often lower. Dividend yields are often higher. Currency cycles shift. Between now and 2030, global growth patterns may change. Europe is investing heavily in green energy and industrial policy. Asia continues expanding technologically. Emerging markets are digitizing rapidly. Owning international developed market exposure adds diversification that many portfolios lack. It protects against single country risk. It adds currency diversification. And it positions you for potential global mean reversion in valuations. No one knows if international will outperform, but diversification isn't about prediction. It's about resilience. Now let's step back. Why these three? Because together they create balance. S&P 500 for dominant U.S. productivity. Equal weight or total market for broader participation. International developed for geographic diversification. You now have growth, stability, rotation potential, global exposure, all with low costs. All liquid, all transparent, and here's something important. The biggest returns between now and 2030 may not come from stock picking. They may come from staying invested consistently, while others overreact to headlines. We will likely see volatility, election cycles, Fed policy shifts, inflation scares, recession fears, geopolitical tensions, but ETFs provide structural exposure without emotional over-trading. Let's address a common objection. What about bonds? For younger investors with long horizons, equities historically provide stronger real returns. For older investors, adding bond ETFs may make sense for stability. But this video focuses on equity positioning for growth before 2030. Now let's talk about execution. You don't need to time the market perfectly. Dollar cost averaging reduces timing risk. Automatic contributions increase discipline. Rebalancing annually maintains target allocations. That's it. No constant monitoring. No daily trading. No reacting to every news alert. The real power is compounding. If earnings grow steadily and you reinvest dividends, even moderate annual returns can produce substantial portfolio growth by 2030. And here's the key idea. We are entering an era defined by productivity acceleration. Artificial intelligence is not just a hype story, it's a cost reduction engine. Automation reduces labor dependency. Software scales infinitely. Data enhances efficiency. Corporations that integrate these tools effectively will expand margins. And broad market ETFs capture that margin expansion. You don't need to guess the winner, you just need exposure. Now risks. Yes, valuations are not cheap. Yes, debt levels are high. Yes, global tensions exist. But markets price risk continuously. And long-term wealth is built by participating in innovation, not avoiding it entirely. If you sit in cash waiting for the perfect moment, you may miss multi-year compounding phases. The question isn't whether volatility will happen. It will. The question is whether you're positioned structurally for growth. These three ETFs provide that structure. Simple, diversified, strategic. Before 2030, the investors who likely win are those who stay diversified, avoid emotional decisions, keep costs low, maintain long-term focus. Not the ones chasing the next headline stock. So if you're building a portfolio today, ask yourself, do I have broad U.S. exposure? Do I have balanced weighting? Do I have international diversification? If the answer is yes, you're structurally positioned. If not, you may be taking more concentrated risk than you realize. 3 ETFs. 1 framework, long-term discipline. That's not flashy, but it works. And before 2030, simplicity may outperform complexity. Because the goal isn't to impress people with your picks. The goal is to build durable wealth, and durable wealth is usually built the boring way. Consistently, over time with exposure to growth,